All right, so we're coming off of one of the worst two-day declines that we've seen, and literal handful about the size that we had on Thursday and Friday. And then we gapped down more than 3% today on the S&P 500, putting us just a few points away from officially a bear market, 20% decline. And at that point this morning, you had tech giants like Apple and Tesla and Nvidia all down more than 5%. And the reason is clear. The global trade war is back on. The 10% sweeping tariffs that President Trump announced last week went live over the weekend. And of course, China immediately retaliated. The result is a wave of selling and a clear shift in market sentiment. But while fear is driving the headline, there's also opportunity. Capital is rotating, and a few sectors are quietly showing some strength. In today's market outlook, I'll walk you through the charts, highlight what's working, and show you what I'm preparing for what could be a very volatile week here. Let's go ahead and get started. Today is Monday, April the 7th, 2025. This is the market outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them or not. Come down here to the bottom, click on this bell if you want to be notified when on your desktops when these videos are posted. And also come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Hit that like button as well. Again, the more you do that, it helps get our content out to all of our followers on these platforms. All right, let's start off taking a look at the S&P 500 and see how it did today with the market forecast indicator. You can see it was down only 0.2%, a quarter of a percent, considering the range. You can see the range today was 411 points on the S&P. That's way more than the average of 125, and that's a high average. 125 points right now is a high level for the S&P, and the range was 400, so a significant range. We had big moves both up and down throughout the day today, ultimately finishing above where we opened down there and way off of the lows, but also off of the highs of the day as we almost got up to yesterday's open at the highs of the day. As a result, when we had a cluster on Friday, we obviously did not have a cluster today. Short-term sentiment improved. The near-term line still, however, is in the lower reversal zone. The momentum line is above the near-term line, is out of the reversal zone, but still in bearish territory. So we are hardly out of the woods. And remember, what we really want to see is when that near-term line breaks 40, is that the momentum line is higher and ideally above 80, and the near-term line, when it breaks 40, that also breaks at least 50, if not 62, so as well. So obviously we're not there. We're still more than 10% below the 30-day moving average. That's still a big level to the downside. But when we do get more than 10% below, we tend to be extreme. And obviously, as you can see, that was quite the battle today. I mean, that's about as much of a doji pattern as you can get. Like, it's relatively small body compared to the body we had on Friday, and also compared to the range. So relatively small body, both an upper and a lower shadow, both big shadows too. So kind of more like a spinning top type pattern, a neutral pattern, but also can be considered a reversal pattern because you can see from a psychological standpoint that the bulls and the bears really hammered it out today. And that usually, sets a reversal. In this case, a low point, because we've been so dramatically lower over the past few days, and today that battle came to a stalemate. Right, the bears had the upper hand, clearly had the upper hand over the last few days, but then, like I said, they battled to a stalemate today, and your short-term sentiment improved to a small degree. Your intermediate line still in the reversal zone. Don't worry about the crossover. They don't matter in the reversal zones. They matter when you're in between them. So it's still in the reversal zone, still below the market sentiment line. Market sentiment line still falling. So we're not like, this isn't like the low. I don't know. I don't know if this will ultimately be the low. I don't think it is the low point yet. I still think we have some downside to go. Though, at 48, with the low point of 48.35, that's a pretty significant low. And if you look at, even looking at the zigzag chart here, you can see, 17.5%, that's still a pretty good number. So there's a good chance that the low is somewhere in today's range. It's as big of a range as it is. The low point is probably somewhere in today's range. But, still a relatively bearish pattern, bearish low points. So we have to, if we're going to break, if we're going to get escape velocity, we need a strong near-term pattern to break such a bearish short-term sentiment. And we'll see if we end up getting that over the next few days. Your NASDAQ 100 actually finished positive, up by 0.2%, but same market forecast pattern, right? The exact same market forecast pattern. Had a cluster on Friday, more than 10% below the moving average, still is. Short-term sentiment improved, but not significantly. Market sentiment still falling, and intermediate line still in the reversal zone. But we did have a small gain. The Dow Jones Industrial Average drop was again, that is a doji pattern. That right there is about as much of a doji as you could possibly get. We end up opening and closing right at the same levels. But again, your market forecast pattern down there at the bottom looks almost exactly the same as the S&P. When the market's really dropping, everything ends up looking the same. Finally, when we look at the Russell 2000, remember the Dow Jones is not market cap weighted like the S&P or the NASDAQ 100. So it's price weighted, and yet still looks the same. And then finally, your Russell 2000 looks almost exactly the same. The only difference is, varying degrees. Your Dow is not as bearish on the intermediate line or the market sentiment line. Your Russell 2000 is actually a little bit more bearish on the market sentiment than the S&P, but they're still, same things. Short-term sentiment slightly improved. Intermediate line in the reversal zone coming off a cluster, still more than 10% below the moving average. And your market sentiment, in this case, is falling in bearish territory. Is actually a lot closer to crossing into the reversal zone itself and getting a cluster with the market sentiment this go around. So a very significant move. Again, big long upper and lower shadows. The kind of stalemate pattern that would suggest that we might be done here. We did get a lower close in the Hakinyashi, and we did get a lower low. But as of right now, you can see the open for tomorrow is going to be right around 1850. We're trading at 1810. That's not very big of it. I mean, there's a decent probability we get a transition candle tomorrow on all of these, right? Even the S&P 500, when you look at the index here, there's a decent probability. Like, again, we're going to open up the Hakinyashi open, be right around 5200, and it's the midpoint of the prior day's body, so right around 5200, maybe plus or minus a little bit. We're trading at 5062, which is again right into this area, so it's actually higher than today's Hakinyashi close. And again, depending upon what it ends up looking like, we might end up getting, if not a transition candle, at least a higher close, which generally then leads to a transition. So a transition candle would be something like this, right here, where you just get a small transition that ends up setting the low point. So that's the kind of pattern I actually expect we'll get here tomorrow. I don't think, again, that we're going up to new highs anytime soon, right? We're in correction mode. New highs, it takes months to get back to new highs. So I still think we have, a lot of time to go there, and we'll talk about that more. But I do think that in the short term, we're definitely setting ourselves up for, a transition to a short-term rally here on all of these major indexes. Let's take a look at some of these other indicators. So let's go to the weekly chart for the S&P. And you can see the bearish crossover, the death cross of the 10-week crossing below the 40-week. You can see the sizable candle for the week. That's a much lower, it's a significant low, and it's a pretty big body here. It's the biggest body we've had in the past 3 years. You have to go back. It's actually the biggest body we had in the past 5 years. This is a bigger candle body, which is what this is measuring, than any body we had in 2022. So we have to go pretty much all the way back to COVID to have a body, to have a size, the candle body be that big. You can see COVID was insane. 2011 was pretty similar, and that set the low point there. And then again, the washout phase of 2008 was also insane. So we're not to those levels, but we are, pretty significantly extreme, considering that we're not in, a significant washout like we were COVID or with the 2008 bear market, where we were below moving averages by a lot by the time we got to that point. Obviously, we have 3 red arrows across the board. That's the issue with being this bearish. You're going to have 3 red arrows. Even if we start to rally here, we're going to have 3 red arrows at least for a few more days towards the end of the week. We are below moving averages. We are way below the 200-day moving average. I showed you yesterday how far below like the 17-day exponential moving average we are, because you can't stay too far down below that. We're still nearly 10% below. That's an extreme mark. That generally means that we're going to rebound and work our way back up to the upside in the short term, right? To get closer to the 17-day, because the 17-day is going to drop pretty rapidly. So it sets a low point. It takes away some of the bearish momentum. So I'm not as concerned about big downside moves right now. Eventually, I think that we'll start to work our way lower again and retest these lows, if not go a little bit lower, because you notice we still haven't touched the 200-week moving average. So there's still an opportunity to get down towards these old 2018 or 2021 highs. So it's just a little bit lower into that 4,600, 4,700 area there. So I think we'll retest these lows to some degree, if not go a little bit lower eventually. But not this week, right? I think this week the downside momentum is probably gone. There might still be some downside, but the strong momentum is gone. I think the margin of safety is set now for a move back up to the value area, back up to these short-term moving averages. Maybe by the time we get there, back up to the 30-day. Though that will be a little bit harder. And again, you'll see how hard it is to get back above the 200-day, because now the 30-day is below it. And you're about to get a death cross with the simple moving averages, with the 50-day crossing below that. If you take a look at the DMI, some of these other oscillators here, starting with the DMI and the ADX, you can see we did drop below 10 again, but this time, unlike last time where your positive indicator wasn't very high, now the positive or negative indicator is very high. It's up to 50. So this is an extreme drop. So again, that sets the low point, right? Whether this is the low point or whether we have a little bit more downside, but the bearish momentum to the downside is done. There's a good margin of safety now that we can be bullish going forward from here, again, in the short term. If you look at the RSI and the CCI, they're at extremes. The RSI is second straight day at extremes, way below 30. The CCI, rebounded from being below minus 300, but it's still below minus 200, so it's still very extreme. Of course, the weekly version is still below minus 200. So remember, we have to be bullish here. We have to get above positive 100. And look at the RSI. It's the worst RSI that we've seen on the weekly chart. Again, going back to COVID, right? You can see back in COVID we dropped below 30, and we briefly touched below 30 on 2011, and of course in the washout phase. So this is a very significant drop and very, very bearish in the short term. Obviously, we are well below the cloud. We're not going to get above the cloud anytime soon. We have a mature bearish trend that doesn't get unmature until we're typically above that, clearly above the blue line. The rate of change is pretty bearish. And then finally, the Bollinger Bands. We did finish outside the bands again. The bandwidth is spiking up to the upside. So again, looking at some context on that. It's not the highest the bandwidth has been. It was higher in 2022, obviously higher in COVID, and then of course in 2018 as well. But this is the furthest below the Bollinger Bands we've been. So that bandwidth is probably going to rise higher a little bit longer. And then when you look at where we are relative to the Keltner channels, the bands are way outside the Keltner channels, and the price is way outside the Keltner. So again, it's rare to be so extreme outside these bands, and the bands, volatility bands, and they're going to keep dropping, and we're going to get back, at least above the Bollinger Band, if not eventually back above the Keltner channel. So again, I'm not worried about more downside right now. I know people were like fretting about 5% drop at the open that we haven't had 3 days in a row of that since the Great Depression, and it's like when we had the open, it was like I was bullish right from the get-go. I added on some bullish positioning overnight when the market opened so far down, because I had an inkling that we wouldn't have 3 straight days of being so bearish, and that's kind of what we talked about in the market outlook last night when I was doing that. And in fact, I put the positions on while I was recording the market outlook, and then we saw what happened here today, obviously. Let's take a look at the intraday chart. Obviously, the 4-week range is blown out. Look how high the 4-week range is, up to 16%. It's a huge, huge 4-week range. Again, setting a low point with the extremes here. You can see the 4-week high point had moved, inward here, and will be here for a while. I don't think we're going to get a new high anytime soon in 4 weeks. But again, we closed. We had a lower high, slightly lower high, a much lower low, but we ended up closing right at last week's low and yesterday's low. And right in the middle of today's range. That's great, right? If we end up with maybe a gapping down to the downside, maybe again, and then we fill up, we get a higher low. Well, there's a good chance we get a higher high, especially considering all the volumes way up here at 560, and we're at 504. So there's not very much. We can move up pretty darn easy because we moved down so fast. A lot of it in very illiquid and very extremely low volume environments. We can fill that in really quickly. As fast as we've gone down, we can go right back up because there's nothing holding us back, right? And you can see, we are clearly, within the 4-week range, still at bearish levels. We made a few attempts to get above the chart, the 4-week midpoint, but we're still in bearish levels. We need to get above 60, if not ideally above 80 or 90 to be done with this decline. And at the very least, we were so extreme the last couple of days, pretty much sitting right on the 4-week lows at the close. Obviously well off of that. Not off of it enough, but off of it enough to not be so strongly bearish anymore going into the rest of this week. If you look at the range, as I said, the range and the volume were extreme, like 254 million shares. The range was 41 points on SPY. So when you look at these numbers in context, that blows away in fact, the normalized ATR is almost at 3%. That's how big. That's a big, big number. Obviously, COVID, blows that away, but outside of COVID, this kind of blows everything else away. So very extreme. You can see the normalized ATR on an absolute basis, or the absolute ATR is actually almost as high as it was in COVID, but since the price of the index is so much higher, the normalized ATR is a lot lower, but still it's a bigger level than anything we saw in 2022. And then finally your VIX also had an extreme today. It actually went up a little bit and got up at one point in time at the high of 54.20 and well above the 125% mark relative to the VIX 3M. The VVIX up to above 150. Again, when you're at these elevated levels, we're so extreme. Like, I expect volatility to come back down. I don't know if it will come back down, into bullish levels below 20, below 95%, or whatever the case may be. I don't think it will get all the way down below 100 on the VVIX, but I think that the top is in on volatility. That we're so extreme to the upside. It doesn't mean that we can't go up some more. It just, what I mean is like the extreme upward momentum that we've had, and you can see the PPO here. So this is, as crazy as this bullish move has been, it actually is like pretty standard. Like we've experienced this before in August, and you saw what happened in August. It came back down. Now it stayed above the 200-day moving average for a few months, and I think that would be the case again. I do think that the moving average now will probably work its way above the 200-day average. Will work its way back above 20. Again, that's what happens when you're in correction mode versus pullback mode, right? When you're in correction, like we were in 2022, you can see it gets above 20 because we're just so bullish for so long. So I think that that's going to happen. COVID did the same thing, and other instances. So we're not going to drop back below the 200-day, I don't think, and start working our way lower like we did in 2023 or at the end of 2022 and throughout most of 2023 into 2024. Before we had that shift in August of 2024, and we've been above it most of the time since. So I think we're in a bullish regime right now for volatility. And if I take a look at the weekly version of this, you can see kind of the same thing, how bullish we've been on a weekly basis. Again, this is the week's not over with, so we still got a long ways to go. But as of right now, this is how far above how high the MACD is. Again, we're looking at COVID, higher than 2018, higher than 15, 16, higher than 2011, and on pace with the washout phase of 2008, way higher than the correction phase of that particular bear market. So again, I don't think necessarily this means that, oh, well, we're going to have, this is going to be like COVID, and we're just going to bounce back up to new highs within a few months, because that's what COVID did. We were back up to new highs within a few months. 1987 was pretty similar. It just took a lot longer to get to new highs, but we established a low very early on, and we were a lot more gradual in the rebound in 1987. So I don't think this has a lot of makings of both of those instances. I don't think necessarily we'll jump back up within a few months. I think that's off the table. I don't think that we'll gradually move up either, like we did in 87. I think that it will look like we're going to get a good, strong move. In fact, I wouldn't be surprised if we get a green tag that's got double digits in it right now. Like, again, it won't happen in a day or two. Now, most of it will happen within a day or two, but I wouldn't be surprised if within the next so many weeks throughout earnings season that we get a green tag of double digits back up towards that 200-day moving average. But I don't think that we get back through that. I think we ultimately will fail there again and retest that 200-week moving average and complete the correction. I think this will be a multi-leg correction. This is the first leg, pull back, failed bounce, first leg of the correction. I think we'll have another leg of the correction and retest these lows near that 200-week moving average before we get to that failed the correction bounce stage to see whether or not that will fail. It didn't fail in 87. It didn't fail in 98 for that matter. It didn't fail in 2020 with COVID. I think it probably will fail this go around because we're a lot more mature in our valuations in the market going into this peak than we ever were in either one of those particular two instances. All right, now let's talk about what's driving a lot of this price action here today. So let's move to the asset class comparison chart and just look at today alone. So pull this up here. You can see the dollar was bullish all day long. In fact, it was the only asset class that was above zero all day long. There was a lot of, look at the roller coaster rides that we had here on the black and purple and brown lines. These are all the U.S. equity indexes, the S&P, the Qs, and the Russell 2000, and you can see like big move higher, back down lower, big jump back up, back down lower, and then we kind of settled down before making a run up to the upside in the afternoon, and then finishing off those highs by the end of the day today. And what was interesting is while lately bonds have been doing very well, bonds did not do very well today. In fact, bond yields screamed to the upside. We closed at 4.15% from 3.98, so about 17 basis points up to the upside. That's one of our bigger moves that we've had in bond yields in quite some time. As you can see, like I have to go back to over here to get a candle even close to being that big. So big move up to the upside. In fact, I don't know if it shows on this chart. Let's see if it shows here. I don't think it will show it by basis points, but it shows it by percentage. And if I were to zoom out on this, you can see how far up we went. So we have to go all the way back to back over here, April 10th of 2024. We also jumped up quite a bit. If I were to look at that particular day, April 10th of 2024, here we go. Then you can see right there, that's the last time we had a day this big. We were above the 200-day moving average on that day, and here we are coming off of a low point. So I think, again, and we're not going to rally up too much. Like we're back up to almost the range of the Fed funds rate, 4.25% to 4.5%. Obviously, the Fed is still being priced in to cut rates, right? Those odds are still there, and that's going to have an impact, right? The rate cut odds are going to impact how these things are going. If you take a look at the June odds, remember that's kind of the first live meeting, as May is a 50-50 proposition, but in June it's not a 50-50. You know, clearly 80%, but the odds dropped. Right, they were at 95% odds of a rate cut in June, and you can see going forward, you know, you have an 83% chance of getting, or 82% chance of getting the second cut in July. So you know, there's still high odds. They're not as high as they were over the weekend, but they're still relatively high odds, and you can see the 2-year is still, you know, was up 12 basis points today, but still way lower, still signifying a path to the downside, even if the path is not necessarily immediate as the 3-month, which is, you know, again, kind of pricing in immediate moves. So if we're going to have one in May, this is going to drop down to the midpoint of the 4 to 4.25% range, and we are still above 4.25%. But with that 10-year jumping up as much as it has, you can see now that we are almost at 52-week highs for the 2-year, 10-year yield spread. And the more this jumps up to the upside, presumably because the Fed is entering a rate cut cycle, then, you know, that's, the markets don't like a spread that rises, right? The market loves when the spread falls and gets inverted. That's, you know, that's when the markets are the most bullish. The market does not like it when it rises up to the upside, especially this far and this fast. So, you know, right now we're not very far up. It's not too bad. We've, you know, in the mid 90s, we kind of got up this, you know, during the soft landing cycle there, the mid cycle adjustment. You know, again, we talked yesterday about, you know, there are periods of time where the Fed just cuts twice, maybe 3 times, kind of spreads it out. And they did that in the mid 90s. They did it in 2019. Did it last year. Just cut 3 times. One of them a 50 basis point cut, but it, you know, only cut a few times and they were done. But this is more when the Fed cuts over an extended period of time, then that's generally when we are in, you know, more of a bear market. See, even 2020 it was 1 cut. I mean, it was a big cut. It was all the way back down to 0, but it was just 1 cut. So it's more of a cycle of cuts that you get, like you see here, when the spread jumps up so significantly. That 1 cut got us up here. You know, this, you know, after that 1 cut, we jumped up to about 150 basis points. But again, that's a lower peak compared to some of these other moves that we had, even in the early 90s, where we didn't even get a bear market. We had a recession, but we didn't even get a bear market during that particular cut cycle. All right, so that's the bond market. So I think the bond market is probably going to end up being relatively bullish here. I think we're going to, again, we're not going to go very far anymore. I probably have most of the gains already today, but we were so extremely low that it's more of a technical rebound, and we'll probably kind of lift up into this area. Probably won't get very much above that 50-day moving average as we rally to the upside. Of course, the other big asset class, like I said, the dollar was bullish, was the only asset class that was bullish all day today. Let's take a look at the dollar index. And you can see, okay, you know, it also kind of had a big washout moment, divergent low point here last week. And then on Friday, we had that Harami pattern we talked about in yesterday's video. And now we're back above the 8-day moving average. So again, we're not necessarily starting a bullish trend. You know, if you look at the market forecast here, which is kind of helpful in helping determine like when trends change. You know, we did cross, we were below 40 yesterday. We did cross 40 and 60, but the momentum line's not above the near-term line, and it's not above 80. So, you know, probably unlikely that will be strongly bullish for an extended period of time, and more likely that it will probably reverse back down to the downside. Of course, the other major asset class that's been so bearish with these falling, with the economic growth expectations really starting to come down, is commodities. And commodities, they did not rebound as much today. In fact, they had a big range, but ended up near the lows of the day. As you can see, crude oil dropping with a pretty good doji pattern itself, but still, like the S&P, short-term sentiment very, very minimally improved. The intermediate line's not in the lower reversal zone like it is in the S&P, but it is in bearish territory now, and the market sentiment almost is in lower reversal zone. So the, you know, it's still getting really hard for crude oil to really get going and make a move. You know, with a weekly cluster here, it's got to be bullish if the market, like economic growth expectations, need to jump if we're going to get a sustained rally in equities, more than just the short-term bump, which is kind of what I'm expecting here. Bitcoin is the other big asset class that is also making a significant move. Here's the weekly chart. You can see getting a bull tag. Remember, if you get a bull tag, that either is a good opportunity for a bounce or it starts a bearish run like we had in 2022. And we're probably looking more at the latter than the former. It had a nice little run to get a bear tag on its daily chart. It had a pullback. This is kind of a failed pullback bounce. And now we're flirting with getting down below 80,000 again and getting to lower lows. And again, this, in my opinion, is a pretty good representation of risk appetite on the high end of the scale, and it's not recovering at all. In fact, it's probably the opposite. It's looking more like it's going to have a hard time getting going to the upside. We've been dark pink shading and a red line for a long time on Bitcoin, and it appears that we're not going to get any kind of recovery anytime soon for that. All right, now let's take a look at the sector moves, and let's look at just today alone, again on the sector rotation. Because you had an interesting move on that. Here's the last 3 months. Of course, technology, the biggest loser, and discretionary. In fact, the only two still that are underperforming the markets here. But let's look at just today alone, and you can see technology was your big winner, along with communication services. Again, not up very much, but considering that technology started the day down 5%, and so did discretionary. So when we talk about Apple, and we talk about Nvidia, and we talk about Microsoft, and we talk about Tesla and Amazon, like all those stocks started off very, very badly at the beginning of the day, but they recovered. It's all except for Apple. Apple's still really having a hard time getting going. You can see Apple closed closer to its lows of the day than it did the highs. It ended up with a cluster here and very extreme in its move. I mentioned also Tesla also had a significant drop today and ended up closing closer to its lows. As you can see, it's still in a bearish trend. Nvidia and Tesla, Apple and Tesla and Nvidia was the other big mover here. And you can see it actually did close a lot closer to its highs. So after starting off and being so bearish, it ended up with kind of a piercing line type candlestick pattern. And it was up 3.5% today. Again, I don't think necessarily that it's changing its trend. It's in a bearish trend right now. But I do think that there is an opportunity for it to make a run back up towards the point of control, towards these intermediate term moving averages, and probably stall towards this old low point, and most likely stall out there again, and probably end up getting a green tag. As you can see, we're on a 22% run to the downside after its last rally. So there's probably going to be we're up 3.5% already. It's really easy to get 5% tags on Nvidia because of how volatile it is. But a double-digit tag, up here towards 107 is very likely, and that's the idea behind whether it's Nvidia or whether it's Apple. The idea now, a lot of these chip stocks, like even Broadcom, which is kind of in the same vein as Nvidia. You can see Broadcom had a nice little move up after again gapping down a little bit of an engulfing pattern. Again, it's got heavy resistance up here where it's at with the point of control and the moving averages, but that's a nice reversal pattern. You can see another chip stock like Lam Research, same thing, kind of a piercing line pattern. They get back to the value area, get back. So I think that the bearish momentum in a lot of these stocks is done. They're, because of how extreme the moves have been. Micron looking the same. I think there's a good opportunity for a lot of these stocks to make a run back up again to these moving averages, back up to a resistance from a volume standpoint, whether it's the point of control, which I don't think it will get up to here, but at least the bottom of the value area. And you can see there's a lot of volume there. So because we dropped so far so fast, we can rally pretty quickly too to get back to those strong, which are now, was a support, but now strong resistance areas on a lot of these stocks here, including Apple. All right, that brings us to our trade idea of the day. Very similar to those stocks I just showed you, Microsoft or Nvidia and Lam Research and Broadcom and all those chip stocks. And it's actually on Apple. And Apple's a little different than those two in that Apple, again, did not close near its highs, actually closed near its lows. So I think it gives us a little bit better opportunity for short-term gain, considering that we haven't had as much of its gain yet. So as move up. Obviously, it's a lot more impacted by China and the China tariffs. A lot of its production is there, hence why it's so bearish. But again, I think as extreme as a lot of its indicators are, whether it's the MACD and stochastics, whether it's the RSI and the CCI, you can see at extreme lows there. Whether it's the DMI, which is also at an extreme. Pull up Apple on the DMI. Well above 40 on the negative indicator, below 10 on the positive indicator, getting a cluster on the market forecast. Here's the market forecast. We can see that. Getting a cluster on the market forecast. Again, the last cluster we had set the low point for a short-term rally, and then the clusters from last April also set a really good low point for the rally up to the upside. And then finally, looking at the Bollinger Bands and the Keltner channels, you can see again way outside the lower band, 24% outside the lower band, way outside the Keltner channel, especially again considering where we ended up. The Ichimoku cloud is strongly bearish, extremely to the, I mean, like you're below -10 on the trend quality indicator. So these are extreme levels. So I'd like the margin of safety element, and I still got the long put that we talked about. I tweeted out today. Remember, a while back we did a bearish trade on Apple, and at the time, it was March 13th, we were kind of like today. We were at a low. We were closed near the low, and we said, okay, let's do a put, and in case it bounces, which we expected it would, we'll do a bull put spread, and we kind of did it at the mid 30 deltas. Well, we're going to do the same thing here because we're expecting a short-term bounce. I don't know how much longer it's going to bounce, but so instead of going to the mid or low 30s on the delta, where I can get a pretty good return, you can see we can get even at the, we need at least $1.16, so we can get that at the 32 delta. Instead, I went up to the at the money, and so was a little bit more aggressive. So that way I can get a pretty good return, about $400, $390. But now I don't have to risk the full $1,000. And remember, the idea behind this is that we can try to get a short-term rally, in this case off the 200-week moving average, which is also kind of a nice little low point. You can see there's a volume node here as well. There's a nice little low here going into earnings. I think we can get a little bit of a relief rally off of this, and then leave that long put on in case the earnings is not as positive as expected, and I don't think it will be. But at least going into that, we can take advantage of a short-term bullish move back up towards resistance, and try to get as much of that gain, as quickly as possible. Right? If we can get it before 20 days, then I'll just close it. Same thing we did before. Close it with at least 50% of the maximum gain or more. Close that trade, take that gain, and then leave the put on and see what ends up happening as we go through that earnings announcement. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.